Hello everyone, and thank you, Eloise. So my name is Alex Maddox. I'm the Capital Markets and Digital Director for Keystone Mortgage, and I run through a few slides on basically what's been going on over the last year in the economy, the housing market, and touch a little bit also on the capital markets over that period. So one thing that was a massive story, particularly in the capital markets over the last 12 months, was payment holidays. And I think for all of us and for all of our mortgage customers, it's great news that the level of discussion around payment holidays has dropped significantly. As you can see from the chart on the right-hand side, we had over 24,000 live payment holidays across our total book, including our service book, at the peak in sort of June, July. But luckily, this has dropped down to below 4,000, and actually recently has been very, very stable. So we've been able to achieve a sustainable exit for a significant number of our customers. But obviously there was a very large operational requirement for dealing with this. And obviously a lot of people in the capital markets were worried about how bonds backed by mortgages might perform if a significant percentage, sometimes as high as 25% of the mortgages, weren't paying their interest or principal on a regular basis. But good news is that has passed, but it was certainly a significant challenge for the wholesale markets during the summer. As you can see from these charts, the cost of funds went up quite materially. So if I look at the chart on the left-hand side here, you can see the cost of funds over LIBOR for specialist lenders like ourselves is the blue line, and you can see how that spiked in May or March actually, and then sort of stayed quite elevated until May, and then gradually declined over time. I've also got in there in the orange line is the VIX index, which is a measure of volatility, which as you can see was a bit of a leading indicator and actually something that I recommend people watch. It's a measure of the US stock market volatility, and it's a pretty good leading indicator of issues coming in the markets. However, although it did feel pretty bad in terms of that pickup in rates to 250 basis points over LIBOR, if we put this in a slightly longer context in the right-hand chart, you can see there that this blip is really tiny compared to what happened during the global financial crisis, when spreads went out to over 1,000 basis points, over 10% over LIBOR. And although this did feel quite material at the time, the actual impact was pretty low compared to what we've seen previously. This did have an impact on the mortgage market, as you can see from this chart. You can see here the total number of mortgage products available. This is through across all products, not just specialists, but it's you can see here that the total products, which is the red line, dropped off rapidly from down to about 25-30% of what it was pre-pandemic, but now has recovered to over 60%. We are still quite low on higher LTV products, and I'm sure everyone on this call will know that better than me even. And we've only recovered to approximately 20% of the higher LTV products that we had pre-pandemic. So the market really does have quite a long way to go. And I think a lot of that concern is because lenders and investors in mortgage-backed products are still concerned about the economic outlook, and I'll touch on that a little bit later on. In terms of lending volumes during the year, I think it's useful just to see the trend over time. So on the left-hand side here, this is the total number of new loans for homeowners, and you can see there that first-time buyers really found it very difficult to get product during sort of early summer, late spring of 2020. Remortgagers did have slightly more luck, and they were able just to sort of get the refinancing done, especially if they didn't have to get a valuation done. But luckily, as you can see from the chart, the volumes really have come back quite strongly, and with the support from the government stamp duty freezes, we're in a pretty good place in terms of volumes getting back to pretty close to where they were in sort of in the same period of 2019. I think volumes have probably slowed down a little bit since this point at the end of last year, but even so, lending volumes are pretty robust. As you can see on the right-hand side, buy-to-let probably, definitely did perform a lot better. It did drop during sort of April, May as well, but the level of the dislocation was not nearly so big, and it's recovered pretty well as well. So you can see there that both for house purchase and for remortgage, the buy-to-let market has been remarkably resilient. In terms of the housing market, we've got two measures here. We've got the house price index. This is the government's index, also published by UK Finance, and then you've also got the blue balances, the RICS market conditions, which again we find the blue line here from RICS is a bit more of a leading indicator of market sentiment, whereas housing transaction data tends to be fairly lagged. But you can see here actually over the last 12 months actually they've been actually less of a lag than you might have expected, and you can see there the significant drop as you'd expect during March to June, but then a very decent recovery in the last few months of last year, and I think all of us have been very positively surprised by how strong the housing market has been through this, albeit a lot of that strength, I think, is due to either quantitative easing or tax changes from the government, but overall hasn't been nearly as bad as perhaps we might have thought it would be. One thing that we spent a lot of time on during the year was talking about how the economy could play out, and so a lot of our stakeholders, a lot of our investors were trying to predict what the economy would do, and so this was, I guess, the view of the different options that could play out when we were, sitting in probably the summer of last year, and I think people felt there were three ways that the economy could come out of the pandemic. There was the L-shaped recovery, which is basically that the economy continues to sort of be on the floor for quite a while, with house prices down 10% and then staying there, unemployment up to 10%, but rates remain low, and then and stay there as the government and the central bank try to support the market. The other option was a U-shaped recovery. Here again, the view was that the housing market would go down by about 10%, but would recover after about a year, and unemployment again would not got quite to 10%, it got as high as 8% in late 2020, and then recovered to 7% per year. So, at least a decent recovery there compared to the L-shaped scenario. And then the final scenario that we and others were talking about was a drop of 5% in house prices in this V-shaped scenario. Unemployment went to 10%, a bit like the L-shaped scenario, but then recovered to 4% within 2 years. So quite a good recovery there. And I think you can see there in all the scenarios, interest rates would be low for quite a while and then starting to rise again in 2021. So that's what we were all discussing in the sort of the middle or sort of third quarter of last year. And I think it's interesting just to look back and see what actually happened. So if we look at house prices, if house prices, average UK house prices in March 2020 were 233,000, average house prices in December 2020 were 251,000, so up 8%, so significantly different to any of those scenarios that we were considering. And the same is true with with unemployment, where we think that all those scenarios were expecting unemployment of sort of 8 to 10%. Actually, it increased from 4% to 5%. So there was a lot of criticism, I know, of government schemes and so on, but the reality is that either by luck or judgment, the actual unemployment rate has stayed remarkably low compared to how bad everyone thought it would get. Interest rates have dropped, and they are down at 0.1%, as you all know, for base rates right now. And there is a chance that the market is predicting they will start to go up. But I think the market forecast for interest rates is still very low. And I think on average over the next 5 years, the market's expecting base rates to be at around 0.5%. So it's it's still, I think, a sort of a low for longer perhaps than any of those scenarios. So I think what we can take away from this slide is probably that the economists got it completely wrong. That's probably not the first time. It's a very difficult job, but I think the good news is that we didn't see any of those sort of downside scenarios that we were worried about. There's still a long way to go, I think, and there's still the whole sort of work out of the pandemic, but a lot better to start in a position of strength a year later compared to where we thought we might be. So in terms of predictions for 2021, the final slide I've got here is, I think the securitization market, where we do all of our funding, will be dominated by the non-bank lenders. particularly Kensington, we're the most frequent issuer of securitisations in the market. We've already done one deal this year. Others have been out there in the market as well. But with all the quantitative easing that's been provided to the banks, I think it's very unlikely that the banking sector comes to market, although the cost of funding is actually very low right now. We've got the stamp duty sort of roll-off, I guess, which has turned into rather than a cliff edge, a gradual hill perhaps. And then we also expect the mortgage market to continue its recovery, particularly as people feel comfortable coming back into the higher LTV space. And I think that's being seen already, and hopefully that will continue. And some of the recent government announcements about higher LTV are probably quite welcome for all those customers out there with a smaller deposit. And then obviously we can't forget the first slide of my presentation around payment holidays. We've got a lot of customers coming off payment holidays, customers coming off furlough, and so for all of us, lenders and mortgage administrators, there'll be a lot of work to do in terms of helping customers get back on track, and to the extent they do need forbearance, providing them with the forbearance they need. So that's it for my slides. I'll now hand back to Eloise, and if you have any questions, please file them in via the chat or at the end. Thank you.